Hi, I hope you're having a good day. I want to make this video and talk a little bit about what's the difference between a hard money lender and a private lender. Today, and I'm making this May of 2022, it's a pretty hot topic in a lot of the industry. So I want to take you back and maybe give you a little history. First of all, I want to tell you that I don't think there is any difference, and I don't even think that's the right question. People use the different terms, hard money lender, private lender, for political reasons and for marketing reasons. But let me take you back a little bit in history, and I'll tell you why I'm jumping to my conclusion and why that's not the right question to ask for anyone. The question is, what's the source of the capital? That's a more important question. When I started the company in 1989, there was no such thing as really hard money lenders. People didn't advertise that. There were lenders who did really what we call hard money deals. And those were really foreclosure bailouts, really the worst of the worst credit. And there were a lot of loan to own shops, and they would charge 18 to 24%, 10 points, 1 year terms. But what we call hard money and private money lending now was called non-conforming lending then. So back then, it was just Fannie Mae, Freddie Mac, FHA, and VA, and everything else was non-conforming lending. And we were a non-conforming lending shop. Somewhere along the line, as a result of government pressure, the government put pressure on lenders to increase home ownership to those who couldn't afford it. Someone came up with the confirm subprime lending. So everyone became subprime lenders that wasn't Fannie, Freddie, FHA, or VA, whether they were a real hard money or someone who's just slightly fell outside of the Fannie, what I call the agency guidelines. So everyone was a non-conforming, I'm sorry, a subprime lender. As a result of the crash of 2008 to 2011, everyone put blame on everyone, and the government put blame on the lenders. And subprime became a very dirty word. The subprime lenders caused all the crisis, and self-understood the government and their regulatory policies didn't have anything to do with it. I say that in quotes. I think they caused it. But either way, and subprime became a very, very dirty word. So then people started to use the word non-QLM. So non-QLM, to most people, means something that's slightly outside of the Fannie and Freddie or FHA and VA, the agency guidelines, but it's not a real dirty deal. And those were, all of a sudden, we had a lot of non-QLM lenders. And for the most part, they packaged those non-QLMs and sold them off in either securitizations, micro securitizations, but ultimately to the secondary market or to Wall Street. And this is what matters most, I think, is where the lender is getting their money. This is what borrowers and brokers should focus on. So then the hard money became in vogue is the word. People were calling everyone who wasn't an agency a hard money lender. And really, what's the definition of that? And you could say Gelt Financial, and I'm only going to speak about me, and our company is a hard money lender. You could say we're a non-QLM lender. You could say we're a private lending company, private money lending. Or you could say we're a subprime lender. Or you could say we're a non-conforming lender. The truth is, it's all of the above. To me, a borrower, and it's only personal opinion, who has good credit, for whatever reason can't go to the agencies, but really is a quality individual and quality real estate. It has nothing to do with quality individual. They have decent credit. Maybe they can't verify their income. I wouldn't say that's a hard money deal. In my mind, that's a soft hard money deal. But that's what I call a private mortgage deal, or just a regular deal. You can call it subprime, you can call it whatever you want. But you take someone who has good credit, maybe they don't verify their income. I'll use that as an example. And we do those deals all the time. And we give them a rate and terms commensurate with that. And then you have someone who, let's say, is in foreclosure for 3 or 4 years. Let's say it's not COVID related. Let's say they have terrible credit. They're just a real mess, but they have a good property. Are they the same hard money as the guy who just can't qualify for a Fannie loan? They're not. They're totally different. So people use the word hard money or private mortgage lending to bundle everyone together. And I think that's an unfair assumption. I think that's a wrong way to look at it. I looked at a bunch of YouTubes, and it seems the consensus is on YouTube, and I disagree with these people, that a hard money lender is generally a company, whether it be a regional or a national company, who's selling their loans to the secondary market, or they're not funding themselves, or they're funding them on a warehouse line and selling them. And I think that's wrong. And they also, a bunch of people with highly rated videos said that a private mortgage lender is lending their own money. Maybe they're a doctor, lawyer, Indian chief, who knows, retired banker, who maybe has $1 million or a couple $100,000, and he's making his own decisions. And I think that's wrong. My definition is a hard money lender is someone who's doing a hard money loan. And to me, a hard money loan is someone who has real credit problems and the loan's really challenged, and they deserve a rate commensurate with that because it's risky. But that's not the same loan that is a soft loan, that is a light fallout. And a perfect example is about 50% of the deals we do at Gelt Financial are deals that are bank quality loans. They can go to a bank, but somewhere along the line, the bank turned them down at the last minute. Someone dropped the ball. We close them on our books. We don't sell them off. And then they refinance us out within 6 months or a year in a bank. To me, that's not a hard money loan. I apologize. I had a pretzel right before this. It was a bad move. That's not a hard money loan. I would say it's a non-conforming loan. But they're all put in the same bucket, and I don't think that should be. We actually used to grade our loans A, B, C, D, and E. Self-understood, A was the best, and E was the worst. I think it may have been F we took it to for a foreclosure bailout was the worst. But I think it should be rated that way. But I think a more relevant topic is whether you call yourself a hard money lender or a private lender. It doesn't matter what you call yourself. You can call yourself anything you want. It's what you deliver. I think what matters, and this is the point I'm hoping to drive across, is where the lender gets funding from, because that will determine how they deliver and what they deliver to the end user, the mortgage broker or the borrower. So let me run through the gamut. You could have an individual who has his own money. Maybe, again, he's a doctor, lawyer, retired Indian chief banker. He has a couple $100,000 or $1 million, and he lends out money. Whatever rate he's charging, whatever term he's charging, he's not going to anyone else. He's lending his own money. You could call him a private mortgage lender. You can call him a hard money lender. And I'm guessing some of the deals he does are hard money and some of the deals are private mortgages. But it's both the same thing. But he's not going anywhere else to get the money, or more important, to make the decision. Or, as important, he's not taking direction from anyone else. He's making the decision based on what he or she wants to do and has the capability to do. Then to the other extreme, you have lenders, again, whatever they're called, hard money or non-conforming lender, or private mortgage money lenders, which the new thing is people don't want to use the term hard money. They want to use the term private mortgage lender. I'm fine with that. I think that's more appropriate, actually. Some of those package their loans and sell them off to Wall Street or some secondary market source. Now, keep in mind when they do that, and there's nothing wrong with that. We don't do that now at Gelt, but there was a time when we did that. There's nothing wrong with that. Nothing wrong with it. It's a perfectly legitimate business model, and it works. Usually, the first guy you're going to get more expensive terms with, but more flexibility. And the company that sells their loans off to Wall Street, usually they're going to offer a more competitive rate, but more restrictive documentation and more restrictive terms, and they're not making the final decision. They say they are, and a lot of lenders say, oh, we're funding the loan, but really they're immediately selling the loan off, and they may fund it on a warehouse line or table fund it or be a correspondent lender, but pretty much as soon as they close that loan, it's being sold off and they're laying the credit risk off. Again, nothing wrong with that. I'm just trying to illustrate the differences. Then you have in between companies that don't sell their loans off and use a combination of their money and outside investors' money. And this is more of a Gelt type approach. So let me back up. I forgot one thing. The company that sells all their loans off, as soon as something happens in the marketplace, they could be paralyzed. So what happened during COVID? There was a few big companies, in fact, probably the top 4 or 5 major companies, whether you call them private mortgage lenders or hard money mortgage lenders. COVID happened and they shut down, they froze, they laid people off, they stopped doing deals. They didn't care if your deal was a day away from closing or not, because they were taking direction from Wall Street or ultimately the buyer of their loans. So if they didn't have an end buyer for that loan, they couldn't originate the loan. And a lot of those loans, they got stuck. They had to sell those loans at discounts because they didn't have the capital to hold them on their balance sheet. So one of the downsides to selling off loans is you're ultimately taking direction from somebody else. And you don't, if that direction changes, it could change on a whim, and they don't give you notice when this happens. I've been doing this for many, many years. You don't get notice. It just happens. They say, we're not buying it. What we bought yesterday, we're not doing today. We're either changing the guidelines, changing the pricing, or something's changing, or we're not doing it. And there's a hybrid. What Gelt Financial does currently, and we've done all of the above, is we use some of our balance sheet, but we also invest or co-invest with some high net worth individuals. Most of them are family offices who frankly are absentee or very passive investors who we build up relationships over years and decades, and they invest their money really riding on our backs. So we underwrite the loans, we close the loans, we service the loans, we don't sell them off. We're not subject to the secondary market whims. And as a result of that, we're sort of an in-between shop. When COVID happened, we frankly did a lot of business because a lot of people got shut down where we were still doing business. There's not one or the other that's better. I've been involved with all three and I just gave you the three, and there's a bunch of hybrids in between. There's fractionalized loans. There's all kinds of other stuff. I'm just trying to illustrate and not bore you to death. We've done all of the models that you could think of. It's not one is bad and one is good. It's what's right for the owners and the company. But my point that I want to drive home, if I was a borrower or I was a mortgage broker, I wouldn't focus so much on what the lender calls themselves. It's where they get their funding and what can happen. Give you another example. We're in an increasing interest rate environment. So in the residential owner-occupied field, what's happening is a lot of lenders took in loans, promised low rates to borrowers. I apologize again. Oh my God, I'm sorry. I'm so sorry. Took in loans, promised a certain rate to a borrower, let's say a 4.5% rate, a 4% rate. And well, the Fed raised the rates. They raised them 75 basis points so far. The Fed announced they're going to have 2 more. They're talking about 2 more raises of 50 basis points each. So a lot of these lenders have pipelines that they promise borrowers rates that they can't deliver on. So what's happening? They're finding they're not going to close the loans and lose money, but they're rejecting loans for, you were 30 days late. We liked your loan 2 months ago when we took the application, or 30 days late ago, but all of a sudden you were 60 days late on a Sears bill in 1967, so we're not doing the deal. Lenders are finding ways to get out of loans because they didn't have the proper hedging, or the company didn't have the proper hedging. So when interest rates goes up and there's a major recalibration in the market, there's fallout. There's just fallout. Pipelines fall apart. And excuse the expression, poo-poo rolls, bad stuff rolls. The big guy in New York or wherever who's buying this says to the lender, oh, I know we have a forward commitment to you to buy $100 million at 4%, but guess what? Rates have traded. We're not honoring that commitment. By the way, that's happened to me time in and time again. So I think what's relevant to borrowers and brokers is to really know what type of operation you're dealing with. Are they lending their own money? Are they making the decisions? Are they subject to selling it to Wall Street, not to selling it? What's happening? And there's another thing which we didn't talk about, which is important, is the guy who's lending his own money, or a company like Gelt who is servicing their own loans. You know who you're dealing with. If you originate a loan with XYZ lender and they're selling it off to the secondary market, they're probably not going to service it. you try talking to them when something goes wrong, when you need an extension or you need a waiver of the grace period. So there's always something, there's give and take in each scenario. The guy who's selling it off in bulk, chances are, to be candid with you, you're going to get the best pricing with them. The guy who's holding the loans, chances are the pricing isn't going to be good, but they're more flexible. Like anything else, there's give and take in this world, but it's not so cut and dry. Who's a hard money lender? Who's a private mortgage lender or private lender? And to be candid with you, it doesn't matter. Again, as I started off saying, I watched the other night 3 or 4 of these YouTube videos, and each one had their own definition. Most of the people who did the YouTubes, no criticism to them. They're not in the business. They haven't been in the business. They don't know what goes on behind the doors. And it's a lot different. So I would ask, if I was a borrower, where do you get your money? That's more important than what you call yourself. There is a trend to get rid of the name hard money. I think hard money has a place, but hard money should be defined as hard money. There's a big difference between someone who is, for example, a foreclosure bailout than a guy who just can't verify his income. You shouldn't put them both in the same basket in terms of risk, rate, and labeling. And they should get different rates, and they should get treated different in terms of the risk level. We at Gelt use a risk reward system, or risk. That's what it is, risk reward. The greater the risk, the greater the reward has to be. It has to offset it. I think some companies do that, some companies don't. I don't know if I went on too long or not. I hope you found this useful. If you did, if you have any questions, leave your comments. Feel free to like the YouTube channel. And again, I certainly answer comments, but I just wanted to make this little video, and it's not so little, 16 minutes already, to clarify what's the difference between a hard money lender and a private mortgage lender. And the answer is there's no difference. There's no difference. It's all marketing. It's all spin. But the real question should be is, where are they getting the money to fund you, and how flexible they're going to be to you? And based on that, you should make your decision. Anyway, take care and have a great day. And I certainly hope I didn't bore you. Take care.